All right, let's jump right in. Have you ever looked at a massive, brand new building and just wondered, how on earth did they pay for that? We're talking about the money behind the glass and steel that literally builds our cities. And to understand it, you have to understand how these deals are put together layer by incredible layer.
So yeah, seriously, how do you finance a skyscraper? $1 billion project. Where does that kind of cash come from? I'll tell you this, it is not one person with a giant checkbook. The real answer is layered, it's complex, and honestly, it's pretty fascinating. It's all about building something called the capital stack.
The best way to think about the capital stack is to picture the building itself. You start with a super solid, secure foundation down at the bottom, and it gets riskier and riskier the higher you go. Each one of these layers is a different kind of money, from a different kind of investor, with a totally different view on risk and reward. So today, we're going to build this thing from the ground up.
Okay, so where do we start? At the very bottom, of course. The most secure part of our entire stack, credit. You probably know it better as debt, and it's the absolute bedrock of pretty much every major real estate deal. This is the first money to go into the project, and crucially, it's the first money to come out.
To really get this, let's give this layer a personality. Meet the cautious banker. Their entire game is about one thing, capital preservation. They are not trying to hit a home run. They're just trying not to strike out. Their goal is super simple. Just get my money back, plus the predictable interest we agreed on. That's it. Safety first, always.
So what kind of return do you get for being so cautious? Well, typically, you're looking at a range of about 6 to 12% a year. Now, it's a solid, reliable return, for sure, but it's not going to set the world on fire. It's predictable, it's contractual, and you know what? That's the whole point.
And this brings us to the fundamental trade-off of being the banker. Your upside is capped. It doesn't matter how unbelievably successful that skyscraper becomes. Let's say it sells for double what everyone expected. The banker doesn't see another dime. Nope. They get their principal back, they get their 6 to 12% interest, and for them, the deal is done.
So let's just recap the world of credit. You're in a senior position, which is just a fancy way of saying you are first in line to get paid. Your investment is protected by the property itself. That's the collateral. You have very little say in how the project is run, and your biggest nightmare, the thing that keeps you up at night, is that the borrower simply stops paying you back.
All right, now let's take the elevator all the way up to the top of our capital stack. Welcome to the penthouse. This is the world of equity. And if credit was all about playing defense and protecting your money, equity is all about playing offense and creating massive, massive value.
So our persona up here is the ambitious developer. These are the risk takers, the visionaries. A safe 8% return? That's boring to them. They're in the business of transformation, of turning a patch of dirt into an iconic tower, and they expect to be rewarded big time for taking on that risk.
And the potential rewards are pretty significant. Equity investors are often targeting returns of 15, 20, 25%, sometimes even higher. This is where real wealth is created in real estate. But just remember where we are. We're at the top of the stack. We are the most exposed if things go wrong.
But here's the beautiful flip side to debt's capped return. Equity has unlimited upside. Once all the lenders, all our cautious bankers down on the ground floor have been paid their share, every single dollar of profit that's left over goes to the equity holders. They get to capture all of the value they create. So let's put them right next to each other because this is the core of everything. The banker gets paid first, but their return is capped. The builder gets paid last, but their upside is unlimited. The banker's biggest fear is the project failing and not getting their loan back. You know what the builder's biggest fear is? That the project only breaks even, because after they pay the banker, if there's nothing left for them, they lose their entire investment. It is the ultimate risk-reward trade-off.
But of course, you're probably thinking it can't be that black and white, right? And you'd be correct. Most big real estate deals aren't just a simple split. The middle floors of our capital stack, the space between the foundation and the penthouse, are filled with something called hybrid capital. This is stuff that blends the features of both debt and equity.
First up, you've got mezzanine debt. Now, mezzanine is really just a fancy word for in between. It gets paid after the main banker, but before the equity developers. And because it's taking on more risk, it earns a higher return, usually in that 10 to 14% range. It's kind of like debt, but with a little bit of an equity-like risk profile. Then you have something called preferred equity. Okay, this one's a little tricky. It's technically an equity position. You're an owner, but it acts a lot like debt. It gets a fixed, preferred return, and you get paid before the main common equity owners, our developers, see a single penny. It's for investors who want a little more juice than debt without taking on the full all-or-nothing risk of being in the penthouse.
So there we have it. We've built our stack. You've got the senior debt at the bottom, all the hybrid stuff in the middle, and common equity at the very top. So the big question for any investor is, where do you want to be? How do you actually choose your position?
Well, choosing your spot is a really personal calculation. First, you have to assess your risk appetite. I mean, can you stomach a total loss? Second, what return do you actually need to hit your goals? Third, what's your view on the market? If you think there's huge growth ahead, equity looks pretty tempting. If you're nervous, debt is your safe harbor. And finally, you have to consider things like taxes, which can make a really big difference in your actual take-home return.
Ultimately, this whole thing boils down to a really fundamental choice in mindset. And this quote says it perfectly. Debt is for capital preservation. It's about protecting the money you already have. Equity is for value creation. It's about taking a risk to build something new and generate some serious wealth. Neither one is better. They're just two different games with different rules and different prizes.
And that brings us to our final thought. After seeing how a skyscraper gets built, from the financial foundation all the way to the penthouse, you have to ask yourself, what's your identity? Are you the cautious banker making sure everything is stable and secure? Or are you the ambitious builder, taking the big risk for a chance to reshape the skyline? The answer to that question? Well, it determines everything.